All right, let's cut through the hype and conduct a calm, data-driven risk analysis of the AI market. Our focus is squarely on 2026, a year that's really shaping up to be a critical turning point for trillions of dollars in global investment. The stakes? Well, they couldn't be higher. So let's dive in. So this is the fundamental question facing every investor, every executive, and every strategist out there today. Are we watching a genuine technological revolution unfold, the kind of thing that comes along once in a generation? Or are we just inflating another massive speculative bubble that's destined for a pretty painful correction? This single question is going to frame our entire analysis. And just to be perfectly clear, we are not here to make a definitive prediction. We're not gazing into a crystal ball. Instead, think of this as a boardroom-ready assessment of the structural factors and the probabilities at play. We're here to analyze the landscape, not to guess the future. Here's our game plan. We'll start with that big bubble or breakthrough debate. Then, we'll look at the valuation warning signs, dig into the execution and profitability gap, cover the major macro risks, and finally, we'll talk about how to navigate what's becoming a new AI arms race. Okay, let's start with the big picture. According to a consensus of experts at Stanford University, the market itself is going through a really fundamental shift. That initial phase of pure hype and evangelism, well, it's giving way to a much more sober, much more demanding era of evaluation. And this quote just perfectly captures this new reality. The market is growing up. It's not impressed by flashy demos anymore. Now it's demanding tangible proof of value. Really, the question is no longer, can you build it? It's, can you make it profitable? This leads us directly to our first major area of risk, the financial markets themselves. I mean, the valuations we're seeing in the AI space are just extraordinary. But what's really fascinating is where all that value is concentrated. As you can see from this chart, the entire AI rally is basically balanced on the head of a pin, an incredibly narrow group of US megacap tech stocks. This kind of extreme concentration creates a huge amount of systemic risk. When the entire market's performance is hanging on just a few big names, any stumble can cause the whole structure to wobble. So, the direct consequence here is pretty stark. Any faltering of optimism, any sign that these few companies can't meet the absolutely monumental earnings expectations that have been placed on them could trigger a disproportionately sharp market-wide correction. It's like a domino effect waiting to happen. Now, whenever you talk about a bubble, everyone's mind immediately jumps to the dot-com era, right? But it's really crucial to be precise here. While the hype definitely feels similar, the underlying fundamentals are very different. Unlike the late 90s, today's AI boom is being led by established, highly profitable companies with fortress-like balance sheets. This isn't about speculative bets on unprofitable startups. This is about a massive capital expenditure cycle by some of the world's biggest corporations. And that brings us from that high-level market view down to the firm level. And this is where we find our second major risk, this widening gap between massive investment on one side and the harsh operational reality of actually implementing this stuff on the other. The scale of spending is almost hard to comprehend. By 2026, worldwide AI spending is projected to blow past $2 trillion. To put that into perspective for you, that is more than the entire annual GDP of Canada. This isn't just an investment trend, it's a capital expenditure cycle so massive it's propping up entire sectors of the US economy, from chip makers all the way to power grids. But all this spending raises the big profitability question. Companies are facing these huge upfront costs with really uncertain returns, which means it's not even clear if these multi-billion-dollar projects will ever be truly profitable in the long run. They're dealing with margin erosion from rising costs for chips and power, and the market is now demanding proof that all this spending is actually creating real productivity gains. The clock is officially ticking. And this skepticism is being echoed by experts like James Landay. The prediction for 2026 is that we're going to hear a growing chorus of companies admitting that widespread productivity gains just haven't materialized yet. The value is real, for sure, but it seems to be concentrated in very specific, targeted areas, not across the entire economy. So why is implementation so darn difficult? Well, data from the State of AI Agents report gives us a really surprising answer. The biggest barriers aren't the AI technology itself. They're these fundamental, nitty-gritty execution problems. Painful integrations with legacy systems, messy data, spiraling costs, and just getting the workforce trained up. The crucial point here is this. AI cannot fix a broken business. As the old saying goes,
Automating a broken process just gets you to the wrong answer faster, but with more confidence. In 2026, execution risk has officially surpassed technology risk.
Okay, so now let's zoom back out from the individual company to the wider system, because even a perfectly executed AI strategy can be completely derailed by external shocks. And this brings us to our fourth major area of risk: macroeconomic and geopolitical triggers. This dashboard gives us a great snapshot of the key threats. First up, interest rates. These high-growth AI valuations are extremely sensitive to the cost of money. Persistent inflation could force central banks to delay cuts or even start raising rates again, which would act as a powerful headwind. Next, you've got resource constraints. We are seeing real bottlenecks in energy, water for cooling, and of course hardware, all of which drive up costs and limit the physical ability to scale. And then there's regulation. And speaking of regulation, here's a key date to watch: August 2026. That's when the EU's Landmark AI Act becomes fully enforceable for what they call high-risk systems. This is going to introduce significant new costs and risks for any company operating in the EU, and it'll set a precedent that other countries are very likely to follow. So, how do we pull all of these interconnected risks together into one coherent idea? Well, the most useful framework I found is what I call the fortress analogy. Basically, viewing the current landscape as a new kind of global AI arms race. So here's how the fortress analogy works. Right now, nations and corporations are spending trillions to build these immense AI capabilities. Think of them as digital fortresses made of data centers and proprietary models. And this spending isn't really optional. It's seen as a strategic necessity. It's a modern form of national power, especially in this escalating technological Cold War between the US and China. But here's the risk, and it's a big one. The economic foundations that are supposed to be supporting these massive fortresses, the proven earnings and the broad productivity gains we've been talking about, they're not fully secure yet. The sheer weight of all this capital expenditure, which is often funded by debt, is creating immense structural stress on the entire system. So, to summarize our balanced view, let's hit 3 key points. First, the upside of AI is absolutely real. In targeted areas like software development and drug discovery, we are already seeing tangible, incredible gains. Second, the risks are not superficial. They are structural and deeply interconnected. A change in interest rates affects valuations, which then affects the ability to fund these big projects. And third, the path forward requires a fundamental shift in mindset. You see, the coming era will not be defined by who has the most innovative algorithm. In 2026, the winners are going to be decided by operational discipline, strong governance, and a relentless, absolutely uncompromising focus on return on investment. The age of experimentation is ending. The age of execution is beginning. And this leaves us with a final thought for every leader and strategist watching. The question is no longer if you will invest in AI. That's just table stakes now. The far more important and frankly more difficult question is how. How are you going to navigate the valuations, master the execution, and insulate your strategy against these external shocks? How will you manage these inherent risks to capture real, sustainable, and defensible value? That is going to be the defining challenge of 2026.